What we're seeing in gold is not a speculative spike like we see at times. This is a structural shift. Most fiat currencies, including the dollar, are terminally ill. It's just a question of how long they take to expire or become worthless. So eventually going back to some form of commodity standard will not be an issue of choice. It'll be a matter of of national survival, of financial, of economic survival.
Well, how can we survive the next financial crisis? I'm pleased to be joined by a new guest in the program, Peter C. Earle. He is the Director of Economics and Economic Freedom and Senior Research Fellow at the American Institute for Economic Research. He's the author of a new book, Gold in Uncertain Times, and the author of several articles recently about gold, which we'll talk about in detail today, about the shifting monetary policy and whether or not we need a gold standard today. So these are all topics that he's covered. And we'll talk about the future of the economic landscape in the U.S. and around the world, what's going to happen to our debt system. Are we entering a debt crisis? All themes of a discussion and much, much more. Welcome to the show, Peter. Good to see you.
Good to see you. Thanks for having me.
Pete, let me start by asking you about some bigger picture ideas here. The number one or two factors driving economic growth that are important to you right now. In other words, barring these items, nothing else is as important. The economy could go either boom or bust because of these things. What are they?
Sure. The first is uncertainty. The high degree of uncertainty with regard to tariff policy, with regard to other policies. I mean, these ideas of putting sanctions on nations that are moving away from using the dollar, whatever. I think those are absolutely crippling to economic growth. And related to that, sort of a subset of that is tariffs itself. Barriers on trade, restrictions from individuals or restrictions of individuals moving things from nation to nation, an abrogation of the law of comparative advantage. Those are the two things I think are right now putting a cap on future growth, and they should be dealt with as soon as possible.
How do you rectify uncertainty? I mean, isn't that a constant in investing in itself?
Right. So, I mean, you can't fully get rid of it, but you can get rid of the parts that are driven by vacillating policies and uncertainty about, where tariffs will be. Will there be tariffs? What will growth look like? Are you going to stop putting out economic data, that sort of thing? So, I mean, there's always going to be some degree of latent uncertainty, but to the extent it's driven by either, promises of policies or by policies that change, daily or weekly, that should be removed, and that would at least give some certainty for entrepreneurs and consumers and investors to deal with the uncertainty that can't be removed.
I showed this graphic to another guest earlier, and I want to get your take on this. So the S&P is down about 5% from its all-time high. Somebody collated big gains and moves, not gains, but moves from several stocks, assets in the overall market since all-time highs. The market correction has already happened for a lot of the big tech companies. And if you go further down the risk spectrum, the losses become even more pronounced. Bitcoin's down 33% from its highs. Ethereum's down 45%. Importantly, the NASDAQ overall hasn't moved much year to date. Yep. And Bitcoin is down on a year that the tech sector is flat, if not slightly up. So why is this happening right now? There is a correction that has been ongoing. It's not a forecast anymore. It's already starting to happen. Why is it happening?
Well, stocks have gone very far without taking a step back. But I would say that, I think that the stock market looks fragile on the surface, but that the underlying macro backdrop is still pretty broadly supportive. We've had mixed breadth. There's some concerns about credit stress, but overall, this environment, despite all the comparisons, is nothing like what we saw between 2000 and 2001. Because back then, we had these high-flying tech stocks. Near the NASDAQ peak, there was a whole bunch of revenue warnings, guidance cuts. We had outright failures in some of the dot-com stocks. And, the differences, one of the differences is that those companies, they never had any earnings. They never had any revenue. Most of them were unprofitable. They were burning cash all the time. But today we see that, a lot of these companies like NVIDIA and some of the others, the really high flyers, and the Mag 7, to the extent that they're outside AI, they have real earnings. They have lots of customers. S&P 500 earnings just posted the strongest quarter since 2021. AI revenue, surprised to the upside. And I mean, NVIDIA's latest corporate earnings report showed real broad-based demand. So, even if you look at leverage, because a lot of these companies are putting on capex to an extent where they have to float debt, most of the leverage indicators are benign. And I think that most of the stress we've seen has been sentiment-driven, not a sign of deteriorating fundamentals. So I'm not going to say I'm bullish or that you should run out and buy stocks. I don't think that things are as bad as the surface level seems to indicate.
I want to play for you this clip from CNBC. Ross Sorkin interviewed Ray Dalio, Bridgewater founder. Shocking title here, getting a lot of traction. And just let me share my screen and sound, and I'll play for you just 1 minute of this 9-minute clip, and then we can react to the first part.
Artificial intelligence, so much more. Bridgewater founder Ray Dalio is with us. Good morning to you, sir.
Good morning.
So you've been providing lessons for us for a very long time about economic cycles and where we are and what's going on. The big question in the market right now, because we're looking at NVIDIA this morning, and I think a lot of people are waking up thinking, where's the market headed next, has been this question of an AI bubble. And I'm curious where you ultimately come down. Are you with Jensen Huang, who says he doesn't see it that way, or do you see something else?
There's definitely a bubble in the markets. Bubbles, what is a bubble? Right?
Okay, what is a bubble?
What is a bubble? A bubble is that there's a lot of creation of wealth from various ways, such as you decide that you're going to have sell $50 billion worth of stock and value it at $1 trillion, or you have multiples like that, and then you create the wealth that way. And then the question with all this wealth relative to money is who needs the money. So it's a matter of who the buyers and sellers are. For example, if we had a wealth tax, right, or if you had a tightening of monetary policy, then there has to be the selling of those assets. So in order to pay those things. So there's a mechanics of who owns it, is it over-owned, and so on. It's not the long-term duration of the earnings. So you think about it, isn't it interesting that we have such a short-term reaction? It's great that what the results are, but this is it's valued as a long-duration asset. So for 25 years, the next 25 years, it's very unknown.
He goes on to later say that people should be holding because bubbles burst when investors need liquidity, and people shouldn't be selling simply based on valuation concerns. We're not quite there yet. But can you just evaluate what we've heard so far?
Sure. So, I mean, none of the things that I mentioned about the market, about the economy, eliminates some of the deeper questions about the scale, the cost, and the payoff horizon of AI. I hasten to remember that early in my career, about 5 years into my career, there's this company called Amazon.com, and it's a company that really sort of remade the world in its image, and it was the only one of the dot-coms, the only major one of the dot-coms to survive. But it saw a 95% collapse in price at one point and took almost 10 years to recover, even when it had earnings. So given the data, the policy posture and liquidity conditions, I would say that pullbacks are more likely to be contained than not, but these are very, very long-term assets, as Ray was saying. I think so too. It's very difficult to see the future. It's even more difficult to see the future when you have a vested interest in it, like many of these firms do. But I really hasten to add that this is not the dot-com era. Even if we were to see 60, 70, 80, 90% drawdowns in some of these stocks, which I don't see how we could see because of their earnings, even if we were to see that, it still wouldn't be the same because many of those firms back then, furniture.com, pets.com, all those, they really had nothing to start with. They were using the IPO process as venture capital. And ultimately, that sort of 9-to-1, failure to survive to success ratio was borne out. But for the first time, or at least for once, it was public investors who are holding those stocks, not VC portfolios. So I think that Ray is basically right. But I don't see the kind of dynamics of a bubble that he does here. Definitely overvalued though, for what it's worth.
Gold is one of the best assets of this year, and you already know why people hold gold. Well, it's because it's real money. But what if your gold could do more than just sit in a vault? That's where today's sponsor, Monetary Metals, comes in. They offer a way for you to earn yield on your gold paid in physical gold. Through their leasing marketplace, you can earn up to 4% yield per year in gold. Instead of paying storage fees, your bullion can now work for you. And because that yield is paid in gold, not cash, your stack grows no matter what the dollar does. Thousands of clients already earn monthly interest in gold and silver through monetary metals, so don't just hold it, put it to work. Go to monetary-metals.com/Lynn, link down below, or scan the QR code here to learn more and get started. If something is overvalued, or if one were to use the word bubble to describe something like Ray used, let's assume that you agree with his overall thesis and position. What do you do then? Because he's advocating for you to not sell. I mean, I don't think he's giving financial advice, but he's saying what he's generally saying is just because something is overvalued, it doesn't mean that people should start panicking and selling their portfolio right away, which is fair enough. Valuations have been poor indicators of price direction. So how does one approach this dilemma, Pete?
I mean, I don't give investment advice, but what I am interpreting Ray to be saying is just be ready for a very bumpy ride. Probably don't want to own these things, with a lot of margin or that sort of thing. Maybe for those who are equipped enough, be ready for either to dollar cost average in, over a very wide price range, a very long time, that sort of thing. I don't know if he's suggesting that people should, buy puts or sell calls. I don't know. But I mean, I think the very basic takeaway is, you may see these things at half of their current price, a quarter of their current price, 25% lower, who knows, over time. These are very long-term assets. And I agree with them. They should be thought of almost more like bonds than like equities, because, we're talking about a very long runway, to the future. And of course, I have to add as well, we don't know that NVIDIA has got it right. It may turn out that these massive data centers that a lot of these AI firms are building, will be invalidated by a single innovation. Maybe some new chip, maybe some quantum computing, development will make it such that what right now takes massive physical infrastructure can be done in a room or two rooms or something like that. So, that's part of the adventure, but it's also a reason why it's not for the faint of heart.
Pete, let's talk about the Mar-a-Lago Accord and basically the themes that investors should be paying attention to from this administration's core agenda. So I'll just read for you a few sentences from this FT article dated earlier in the year. Will anybody buy a Mar-a-Lago Accord? Donald Trump's chaotic trade policy can only lead to economic chaos. This is an opinion piece, clearly. So might the Trump administration stumble upon something both more coherent and less damaging, yet still meet the president's protectionist claims? Perhaps some members, including Scott Bessent, Treasury Secretary, and Stephen Myron, Chair of the Council of Economic Advisors, believe so. Tell us about the core pillars of the Mar-a-Lago Accord and fundamentally how will assets change in accordance to this new doctrine.
Sure. So the Mar-a-Lago Accord is based upon an article called something along the lines of how to restructure the global trading system. And the deep logic here is to re-engineer the structure of U.S. economic power. And it does so by trying to pull on four levers. The first is the one we've seen the most of, and that's tariffs. Tariffs are essentially, used as a way of generating income and sort of, making the massive, 25 or 28 trillion dollar U.S. economy, sort of weaponize it against other countries, or at least use it for leverage. The second is restructuring the treasury market. The idea being that if we can stretch out the maturity of treasury bonds and get lower yields, that we can kind of put off the issues with debt for a while and alleviate a lot of the strain from debt service and all that sort of thing. There are issues with each one of these, but I'll just go over what each of the pillars are. That's the second pillar, restructuring treasuries. The third is to walk down the dollar, the idea being to reduce the value of the dollar in order to boost exports and make American goods more competitive. We saw that a little bit in the 80s, 1985 with the Plaza Accord. That's one of the plans here. And then the fourth part is to reevaluate longstanding treaties and agreements, longstanding security agreements, where the U.S., many of which took place after World War II. The idea is that in many cases, some allies, they should be paying in more. Maybe some of those agreements are costly in ways they don't need to be. So those four elements are meant to be used in a way that changes the U.S. standing in the world. And I mean, there's some issues with each of them. I mean, I think we've seen with tariffs so far, the uncertainty of putting on these tariffs and then taking them off and changing them and, putting a 50% tariff on copper for 2 days and then taking it off. Those sorts of things do a lot more harm than good. Do you want me to go on with tariffs? Do you want me to speak about each of those, or where would you like to go next?
Let's start with the dollar first. I'm curious to get your long-term take on the dollar. And
Right.
now we know that Trump and his allies want the dollar lower, and
Right.
I want you to just tell us about how he may accomplish this, if that's still their objective. Are we going to see, and if so, if this does become something that they're doing successfully, are we going to see long-term structural weakness of the dollar versus other currencies, or do we see a race to the bottom worldwide?
It's a really good question because, a cheaper dollar makes imports more expensive, but that includes things like energy, food, industrial inputs, and that, can have inflation-like effects at home. And it also affects the U.S. position as the issue of the world's reserve currency, right? So the dollar keeps our borrowing costs low and it underpins global demand for U.S. treasuries. And we saw it throughout history, especially, for example, with the Plaza Accord. We did see short-term gains from the attempt to weaken the dollar, but then over the long term, we saw more volatility and we eventually saw an explosive move upwards in the dollar. A couple of factors there is that, first of all, right now, in order to get a weaker dollar, you would have to get a lot of American competitors to buy into this. They would not only have to, sell their own currencies, but they'd have to basically sell the dollar and buy up their own currencies. And doing that is directly against their own interests. So even if they say that, I'm not sure they're going to want to do it. Plus I mentioned the inflation effects, but also, if you do this sort of thing with the dollar, many other countries are probably going to get involved in a competitive devaluation. And for countries that have smaller currencies or less liquid currencies, it's a race to the bottom that America doesn't want to win. It's much easier for smaller countries to devalue their currencies than the U.S. So I mean, that's a big issue. I mean, and the only other thing I'd add is that, the president has said, this administration has said that they want foreign companies to come to the U.S. and invest in the U.S. Well, if you ask a giant Korean or Japanese or German company to put a huge manufacturing plant in the U.S., the first thing they do that is buy up dollars. And when they buy up dollars, they increase the strength. So that sort of thing is directly at odds with this pillar of the Mar-a-Lago Accord. And it's a risky thing to do anyway.
Well, you brought up the Plaza Accord several times, and I was just pulling out some stats as you were talking, Pete. So after the Plaza Accord was implemented, the yen depreciated. Sorry, the U.S. dollar fell against the yen and the mark by 50% in 1987. So the Plaza Accord signed in the Plaza Hotel, New York, 1985. 2 years later, successful, the biggest FX intervention, coordinated FX intervention by 5 central banks ever in recorded history. We're not seeing that to this level and scale yet, but I do want to point to you that the yen has been moving dramatically against the dollar over the course of the year. And I'm just going to pull this chart up for you and we can talk about it. Maybe this was a direct result of Trump's policies, maybe not. But as you can see, that the yen has been weakening structurally for quite a number of years against the dollar, but this has accelerated exponentially this year.
Yep.
So maybe it's work, but then again, you're thinking like the dollar should be weakening, not the other way around.
The dollar is down about, relatively speaking, against a basket of, I believe, 15 currencies. The dollar was down about 9.5% this year.
Correct.
Which
Yes.
is astronomical in dollar terms. But I mean, the thing about the thing about the Plaza Accord is, we did see some successes early on, but if you look 10 years later, the dollar, was up an order of magnitude higher than it had been. So these are short-term, moves. These are sort of, I would say, they're superficial, sort of cosmetic moves. If you really want to strengthen your currency or weaken your currency, you'd have to change the nature of trade, the nature of your industrial base, that sort of thing. And so, I mean, these may deliver short-term benefits or short-term gains, but to be really lasting economic change, you need structural change underneath.
Here's my theory. So Donald Trump partly instituted or enacted the tariffs early in the year to purposely engineer a weaker dollar, because maybe they didn't have an official accord or an official agreement between central banks to intervene in the FX markets, or maybe they did behind closed doors, I don't know. But certainly it wasn't the same structure as the Plaza Accord. Now that the dollar has weakened per his agenda, we're not going to see as much tariffs anymore, therefore more certainty in the markets. Does that theory make any sense, or can you find some holes in what I just said?
I mean, it does make sense. Frankly, I hope that you're right. But the one thing I would say is that I mean, I think that the administration has grown to rely on the threat of tariffs, if not actual tariffs, which means that's a tool they probably won't get rid of. And that means, again, a higher average latent amount of uncertainty in the markets, which is, it's just not something we want. I mean, one of the things I noticed is that, the recent trend in both business sentiment and consumer sentiment was actually very, very bad. I believe the current sentiment of the University of Michigan number was either the lowest ever or the second lowest ever this last month. I mean, that's a really sort of lousy state of affairs when we have prices rising again. Disinflation seems to have stopped. So again, if we could knock out that portion of uncertainty, which can be wiped out, we'd be all the better for it.
What's the bigger risk right now? Unemployment, higher unemployment, or higher inflation?
Ooh, wow. Well, I'll tell you, I think right now that it's unemployment because we see some, if you look at the state WARN reports, once we reach a certain point where state WARN reports reach above a certain level, you tend to see unemployment kind of picks up a momentum. We're seeing a little bit of that. I mean, the early stages, in some of the early stages we see right now, what we're seeing is not necessarily a lot of firing, but we're seeing some layoffs, but a lot of non-hiring. A lot of firms, that might have said they were going to hire 5 or 10 people this year, they're going to hire instead 3. They're going to hire 1 or none. So I mean, that's the first stage. But my concern is that the Fed may have waited too long to start lowering rates, and they may be playing catch up at this point. I hope that's not the case. But I mean, again, this uncertainty has led a lot of businesses to hold off on capex and expansion, and it's a dicey situation.
There seems to be, and I'll talk about your work on analyzing the historical implications of the gold standard and applying it today. You've written several pieces about this. You've even got a book called Gold in Uncertain Times, which I want to discuss with you now. But before we do, is there a bigger gold rush happening? Like literally, I mean, Tucker Carlson announced that he's starting a gold company. The Tether, the stablecoin company, earlier in the fall announced that they were buying gold. They're adding to their gold reserves over 116 tons to be exact, value between $8.7 billion to $12 billion, depending on the market price. Meanwhile, Bitcoin miners have been reported to sell Bitcoin to pivot into AI. So it looks like there's this narrative shift from Bitcoin to gold, at least on the surface. I don't know if that's actually what's going on, but that's what it looks like. What is going on?
Yeah, I think it's structural. So, what we're seeing in gold is not a speculative spike like we see at times. This is a structural shift. We have central banks that are buying at the fastest pace in decades. BRICS, including and especially China, India, and some of the emerging markets. Some firms are buying simply because they want to hedge away from the dollar because they saw what happened with Russia getting kicked out of SWIFT and all that sort of thing. And, on top of that, we've got dollar uncertainty, both because of the Mar-a-Lago Accord, the walking down the dollar I mentioned before, and tariffs. And that's paired with geopolitical uncertainty, where every major region in the world right now, Middle East, Southern Europe, et cetera, has some degree of instability. So I think the key tell is that gold is rising despite decent equity markets and still high nominal rates, which means, this move is more about a reassessment of gold, a remonetization of gold, and insurance, not panic. And I would just add that the market structure out there supports that interpretation. We have ETF flows, there's physical demand, even large sales like the recent Russian gold liquidations, they haven't dented the price. We're still at, $4,100 an ounce. So, that suggests how deep the current demand for gold is.
Do we need a gold standard? And I'll let you answer this however you like. I know we've only got a few minutes left, and I know you've written literally books about this topic. But how have gold standards functioned in the past? Have they achieved their purpose? Do we need that same purpose today?
Well, I mean, the one thing they do is they arrest spending and they make it easier for individuals and businesses and governments themselves to plan long term. They provide an anchor for value such that people can vote with their feet if there's monetary expansion beyond the gold standard, if it gets abrogated. And what we see is that when we've had a gold standard, we tend to get a very mild deflation over time, which means a sort of a gentle falling of price, partially driven by productivity, partially driven by the kind of long-term planning that arises from that sort of stable anchor of value. And I mean, I've heard a lot of people say it would be impossible in this day and age. They sort of link. There seems to be a link between technological advancement or innovation and the gold standard. It's not true at all. What I would say is that it might take a while to make that sort of conversion. I think in the short term, we could do some small fixes to sort of end or arrest, the pernicious aspects of central banking. But in the longer term, some sort of commodity-backed money, whether it's gold or silver or something else, would be a way of, really putting an end to some of the pernicious aspects of fiat currency and the effects it has on every aspect of the economy.
You wrote this interesting article called Forgetting Gold.
Yeah.
And here, let me just sum this up here. Gold became a museum piece in the public mind, not because it failed as a monetary technology, but because it obstructed a coalition of interests, fiscal, bureaucratic, and financial, that profit from discretion.
Mm-hmm.
What do you mean by this?
Well, what I mean is that whenever you have a system where political officials or bureaucrats or technocrats are charged with making decisions, they over time there's creep, right? So I mean, the Federal Reserve, might have been started to arrest bank runs and to sort of even out, create an elastic currency to even out seasonal flows, and then over time you have the addition of the maximizing unemployment mandate. You have medium-term interest rates. You have a stable price level. You have bank regulation and the many, many other things that the Federal Reserve has been charged with doing. And so, when you have this sort of anonymous or it's not really a good description, or, nominally automatic system like the gold standard, where there's a certain value that the money is pegged to, it doesn't require a lot of intervention. When you get intervention, when you get discretion, you get errors, you get interpretations, you get individuals who can be influenced by political powers. So there's just a whole host of things that are avoided when you have a system that's sort of self-guided or self-driving like the gold standard is. It's not a great description, but it's a moderate description of how it works.
Can we summarize this as gold was obsolete as a financial instrument and is no longer?
Can
you summarize the perception
Sure.
of gold as gold being obsolete as a financial instrument at one point in modern history and
Right.
now is no longer obsolete because of structural changes?
Sure. So when we went off the gold standard, the last vestiges of the gold standard in August of 1971, the view was that, we could have a fiat-backed economy, a fiat currency economy, and that we had, these great officials who are highly trained and have, batteries of PhD economists with lots of data, and that they could essentially engineer better outcomes with money than could be had using a commodity-backed standard. But looking at the destruction of purchasing power of the dollar, looking at the massive tidal wave of $38 trillion of debt that we're now underneath, and all the other effects of 50-something years of fiat currency, gold has always been there. And it's, I've always viewed the period of time in which the U.S. went off the gold standard as an interregnum, that eventually we'd have to go back to gold or silver, some of the metal, not because we realized that it was better, but because we would have to. That will be the only way of arresting the slide that we've seen in most areas of the economy under a central banking dollar, a central bank managed dollar.
What happens to investment theses, or basically how does the fact that gold no longer looks forgotten based on just the price action, the volume and interest alone in the media, what does that mean structurally for investors going forward?
Well, I think one thing that's going to happen is, and first of all, I should hasten to mention that none of this means that gold goes from here to 10,000. Gold may go back down to 2,000 or 2,500. It may go up to 6,000. Who can say? But I mean, one thing we know for sure, and that is that there's always demand for gold, and that the march upward has coincided with a growing realization that that most fiat currencies, including the dollar, are terminally ill. It's just a question of how long they take to expire, become worthless. So what it means for investors is that my first guess is that gold will achieve a place in portfolios similar to one that, say, bonds have or something like that. Up until now, people would say, well, you should have some stocks, you should have equities, you should have some bonds, and then maybe some commodities or some other stuff, maybe some gold. I think it's going to become more imperative in the medium term, maybe in the short term, where investors have some exposure to precious metals, whether that's gold and silver. I'm not sure about platinum, palladium, those sorts of things, but that's the first thing. And the second thing is, I wonder if over time, as fiat currencies get sicker, if we won't have a popularization of the various metrics which measure, for example, things like stock prices, things like bond yields, conventional financial metrics being measured, not in dollars or index points, but in gold. There's a gold to copper ratio. There's a gold valued S&P 500, that sort of thing, or there's a conversion of the dollar values. I wonder if those will become more popular over time, because it will just be a reflection of the fact that gold is less malleable in terms of its value than fiat currencies are.
In your article called "The Gold Standard Explained," which summarizes how it worked in the past and the functions of a gold standard, I want to just highlight this particular paragraph here. Fiscal and monetary discipline, linking money creation to gold, restraining governments from overspending. You just mentioned that. Or financing deficits by printing money. Monetary policy was effectively automatic. A nation could not expand its money supply unless it acquired more gold. For this reason, advocates view the gold standard as a guardrail against political manipulation of money and a deterrent to reckless borrowing. So far as we know, the administration is not seriously proposing or considering a gold standard, at least not in the inner circle of the Trump administration. And so what happens theoretically if this lack of discipline, this lack of fiscal and monetary discipline goes unchecked?
Well, I mean, we've seen a lot of that over the last 50 years, but I mean, to a certain extent, you have a increasing devaluation of the unit currency, in this case, the dollar. You have rising levels of debt. With those rising levels of debt, as that debt pile rises, there's more and more risk that eventually somebody's not going to receive their money back. They're not going to get their principal back. So you would have rising yields. With rising yields comes more strain from the debt burden. And one has to imagine that, any level of spending that's dependent upon bonds means we have to continue to issue bonds, which means eventually, if there's no market for those bonds, the Federal Reserve will have to basically buy those bonds directly. So there's a sort of like a conveyor belt or a treadmill that just moves faster and faster, and eventually it winds up with either direct printing of money or very high confiscatory levels of taxes, or all of the above, financial oppression, that sort of thing. So I mean, eventually, as I've said and as I believe, eventually going back to some form of commodity standard will not be an issue of choice. It'll be a matter of of national survival, of financial, of economic survival.
Well, how can we survive the next financial crisis? However it may happen, whenever it may happen, in whatever form it happes, let us know. We'll end here.
I mean, it's good to be hedged. It's good to do things, outside the realm of investment. To try not to have too much debt. To try to acquire skills that are still marketable in a recession or something like that. Stay aware. Keep one's eye on. Keep your eye on shows like this and other financial media, and just. I guess don't get sucked into the propaganda. Fundamental value was always found in commodities and hard goods like land, gold, silver, that sort of thing. And eventually, for all the good that financialization has done, eventually a lot of those things are built on very sort of flimsy foundations, and those will eventually be discovered or be demonstrated, if there's a real economic collapse or hardship. Hopefully we don't wind up seeing that, but I mean, it's not like most governments to turn around while there's still time.
Okay, excellent. Thank you very much, Pete. Appreciate talking to you. Where can we find more information about you or learn about you and read your work?
So most of my writing is at AIR.org. I'm Peter C. Earle, and I have a Twitter account, which I use sporadically. And, Yeah, that's it. I'm around, I guess you'd say.
All right. We'll find Peter around in the links down below. Thanks very much, Pete. Speak next
Thanks for
time.
having me. Yep, you too.
Thank you for watching. Don't forget to like and subscribe.